The US dollar is trading near a two-year high against major currencies like the euro, the British pound, and the Japanese yen. That follows comments by a senior US Federal Reserve official hinting at the more aggressive withdrawal of support for the world's largest economy. Governor Lael Brainard, who sits on the central bank's policy-making body, says quicker action is needed to keep inflation in check. Consumer prices in the U.S. have gone up by record levels, partly due to hikes in the price of oil linked to the crisis in Ukraine. To ease those pressures, the Fed is expected to raise borrowing costs by more than usual. It's also preparing to more rapidly sell off government bonds and other securities that it's accumulated over the past 2 years. That would effectively suck hundreds of billions of dollars from the economy. Now, for more, let's go to Craig Erlam. He's a senior market analyst at OANDA in London. Welcome back to the program, Craig. Now, a more hawkish Fed, of course, their mandate mainly is to tame inflation, and we're seeing some gyrations already in markets. But can you tell us what the effect is going to be on the real economy outside of Wall Street?
Well, that ultimately depends on how far they go. The markets are pricing in a very aggressive tightening cycle at this point. They're pricing in a 50 basis point rate hike at the meeting in May. That would be the largest rate hike that we've seen in more than 20 years, and potentially one or two more of them over the coming months as well, with basically a rate hike at every meeting. That's a very aggressive tightening cycle. That's going to lower growth naturally because of the rate at which they are raising interest rates, something they wouldn't typically want to do. And the question now becomes, will it tip the economy into recession? The economy in the US is very strong currently, but the yield curve, which is effectively a plot of all the yields on government bonds over the course of the next 30 years, would suggest that we are going to see that, because current recent yields, so 2-year, 1 year, are higher than the longer term yields. That suggests that the Fed is going to raise interest rates rapidly and then have to be forced to cut them again because they tip the economy into recession. So the markets do seem to now think that we are heading for a recession, partly driven at least by the rapid tightening cycle that the Federal Reserve is undertaking.
So a recession in the world's largest economy, what would that mean for the rest of the world? I mean, they are the biggest economy in the world, so anything that happens there will have lots of knock-on effects.
Absolutely. The old saying, if the US sneezes, the world catches a cold. I think that is very much the case. But I think it's also bigger than that. The Fed isn't the only central bank doing this. The UK central bank, the Bank of England, has raised interest rates 3 times already and is expected to continue. And the markets are pricing in still a very aggressive tightening cycle. The ECB, which only 6 months ago looked years away from an interest rate hike, now the markets are pricing in 4 or 5, 10 basis point rate hikes this year. And other central banks are doing the same thing as well. The Australian central bank, the Canadian central bank, many of these central banks are all singing from the same hymn book ultimately, which is that inflation is rising faster than expected. It's far higher than they ever anticipated. It could still go higher again, and all at a time when commodity prices are already extremely high as well. So that should keep the pressure on the central banks to raise interest rates much faster than they would otherwise like, and that is going to pressure the economy ultimately.
Right. Craig Erlam from OANDA in London. Always a pleasure to have you.